Sep Niakan here with Blackbook Properties and Blackbook.com, and today we want to save you in real estate taxes. I have a wonderful guest, Mr. Daulong of Southern Management Solutions. He is a tax expert, a CPA, and he is local here right in Miami. We're going to talk about ways you can save on real estate taxes. Let's do this.
It's amazing. We've been talking about doing this video for a long time, and here we are.
So let's talk about tax tips for primary homeowners.
Listen, tax considerations are obviously something that we all have to take into consideration, especially here in Florida. You know, the primary source of revenue for the state is your property taxes. One of the great programs that we have here in Florida is the homestead exemption program and the Save Our Homes. Essentially what it does, it is a reduction in your assessed value up to $50,000. Which is eligible to all Florida residents, and that
saves you about $1,000 a year, roughly, the homestead part of it, exemption.
Every dollar that you can put inside of your pocket and keep it away from the government, it's better. And Save Our Homes is a big one. You know, with the prices of real estate going up every year in South Florida, essentially what it does, it caps the rate at which the assessed value can increase. It's capped to 3% or the CPI. Well, obviously CPI has been going up pretty rapidly, but it's still a good savings because it tends to lag the actual home value increase.
Absolutely. So let's say you bought a property for $1 million and a few years later it's worth 1.4. That's a 40% increase, but in those 3 years, let's say, your taxes could only go up roughly 3% each year, which is significantly less than your property value having gone up the 40% total.
It's a big deal. Big deal.
It makes a huge impact. I don't know if it's part of the Save Our Homes, but it's associated with it. There is a benefit to investors in Florida as well, which is property taxes can't ever increase more than 10% for investors, and I think that's an important thing for people to know. So for homeowners, it's a 3% increase, and for investors, it's a 10% max increase per year. And what happens when you sell your property and move to another one?
Anybody who owns their property and is looking at capital gains, because if you buy and you sell at a higher price, you're going to have to pay capital gains tax. Every individual has $250,000 exemption when they sell their personal residence, their primary residence, if they've lived in it for 2 out of the last 5 years. For married couples, up to $500,000, which is really a gift.
Imagine making a $500,000 profit off of selling your home and paying $0 in taxes to Uncle Sam. Everyone should take advantage of it because that is massive. What about portability, the state portability benefit?
Yeah, so portability, essentially every place that you move into as your primary residence, you bring that benefit of the homestead exemption and the Save Our Homes to that new property. The only way that you lose it is if you stop using that home as your personal residence and you say you put a renter in.
Let's say you buy a property for $500,000 and it goes up to, over the course of a few years, to $1 million. Roughly, because of the Save Our Homes tax increase cap of 3% each year, maybe your assessment now might be something like $650,000 that you have to pay taxes on, but your property market value, what it sells for, is $1 million. That difference of what it would have been assessed for and what your Save Our Homes caps you at, let's say it was $300,000. You can take that $300,000 assessment savings and port it, that's why they call it portability, port it to your next property. So now your next property that you buy for $1.5 million, and they would otherwise assess it for, let's say, $1.5 million. They're going to subtract $300,000 and assess you off of that number. That's a huge tax savings because if you consider that $300,000 assessment savings is going to potentially save you $6,000 or so in taxes, in property taxes.
Yeah,
so
big deal.
It's a big number.
The portability is essentially a way for you to transfer your benefit that you've accrued as being a resident of Florida, and you can transfer it to your new property.
So there's some folks that call me and say, hey Sep, I prefer to put this property on an LLC. I've heard it's a good idea. When is it a good idea to put a property into a LLC, and when is it not?
Yeah, so an LLC, in my opinion, and based on my experience is a superior vehicle than a corp, an actual corp. An LLC is a great vehicle in order to keep real estate. My suggestion would be that if you want to use it as asset protection, that's the main purpose of the LLC.
Let me ask you a quick question before you continue. Someone's buying as a primary homeowner. Should they ever put their property in an LLC or corporation?
So that depends on whether they are a U.S. citizen or a foreigner. U.S. citizen, a resident, and a Florida resident, I would say in their own name all the time to take advantage of the homestead exemption and the Save Our Homes.
And the federal taxes as well.
And the federal taxes as well. Thank you.
So primary homeowner, U.S. resident or citizen, always put it in your name. Of course, speak to your attorney and your accountant. Perfect one right here. If it's not a primary resident, what if it's a second home and so on?
Essentially, there's a distinction, right, between personal use home and a business. So it is possible to do both. If you want to set up your home and rent it part of the time and use it, you can still keep it as an investment, but you're limited as to the amount of time that you can actually enjoy it and spend in it. I would say that it's a good thing to keep real estate in an LLC. I would say that because an LLC is what's called a hybrid entity, can be treated as a pass-through or it can be treated as a corporation. My recommendation is that for U.S. persons to elect to be treated as a pass-through or a partnership, if it's more than one member. For foreigners to actually keep it as a C Corp and not a pass-through. The only reason why I say that is for efficiency purposes. It goes against my own interests because obviously I get to do more tax returns. But it's just simpler. But the truth is that properties in general, because you have a lot of non-cash expenses, they don't generate a lot of profit, right? They're cash flow positive and tax kind of neutral or tax loss.
Okay. So when you say they don't yield a lot of profit, you're talking about on the books in terms of tax profit.
Correct. Taxable income is usually zero or a tax
because
loss.
Of depreciation and so on.
Correct. And another thing to consider is, if you make improvements to the home, you can actually deduct those in the same year. You don't have to capitalize them or amortize them. That's if it's a pass-through. Yeah, pass-through.
In terms of second homes, what can our second home buyers do of the things we've talked about to help save on taxes?
Let's see, you have deductions on all the expenses, all the taxes. You have unlimited mortgage interest deduction for anything placed in business. And then another obvious one is the 1031 exchange. Tax planning 101, the main thing that you want to do is you want to accelerate your deductions and you want to postpone your income. So 1031 exchange is essentially when you have a property that you keep for business and you sell it, and within a certain period of time you reinvest it into a property and essentially you defer the capital gains until the next go around, which is a great benefit because you're deferring that income to the future.
Yeah, deferring that income and taking all of those profits and all of the equity and compounding it, right? It's the whole concept of compounding your money.
That's it.
So what is the difference in terms of taxation of a second home versus an investment property that's being rented out?
The difference is how you present it on your tax return. If it's an investment property, it goes on what's called Schedule E, which is rentals and royalties and stuff like that. And if it's just a second home, well, it doesn't go anywhere. It's basically just there. You don't get the benefit of the deduction of any of the expenses.
Okay. And also, since it's not a primary home, you don't get the benefit of homestead and Save Our Homes and all that stuff, right?
Correct.
Your number one tax tip for primary homeowners, what is it?
It's got to be the capital gains exclusion after 2 years, 2 out of 5 years. I mean, that's a gift, and actually down here in Florida, I've met people who move every 2 years because of it, because they get into a home and the next year it's worth 20% more, and after 3 years it's worth 50% more, and then they sell it and they take their money tax free and they rinse and repeat.
Rinse and repeat. So they take the profits, go get another good deal, stay in it for a couple of years, sell it again, and all along 100% tax free.
Yeah, and they're taking the homestead and Save Our Homes exemptions at the same time. Yep.
Wow. Yeah, that is a sweet deal. What's the number one tax advice for second homeowners?
Second homeowners, if we're talking about people in Florida, I would say make Florida your primary home. no matter what, because Florida is just a tax-friendly state. The weather's better down here. We have beaches, so it's a better place to be all around. So that's my number one tip.
That's a good tip.
If it's a secondary home, make sure your secondary home is like in Chicago or New York.
Okay, there you
or
go.
Or somewhere else.
So the second home tip is make Miami your primary home. Make somewhere else your second home. That's a great tip, man. And then what about for investors? Your number one tax tip for investors?
So number one tax tip for investors is, first of all, take advantage of accelerated depreciation, which was a gift from Trump, from the Tax Cut and Jobs Act.
Can you explain that real quickly?
Yeah, absolutely. So an example, you buy an investment property and you put a new kitchen and new flooring and you can essentially write off that $100,000 that you spent and actually you can generate a loss on that property, which flows through and offsets maybe W-2 income or income from other sources. And then what that does, it reduces your basis in the property, what's called basis. But the truth is that if you're 1031 exchanging, it doesn't really matter because you're not going to have to worry about that basis. You're going to defer the gain anyways. So take advantage of the depreciation, write everything off, generate losses. Bring it against other income, which, for example, salary income, it's kind of impossible to bring down unless you have losses. So those losses help bring your taxes down, and then the 1031 exchange allows you to defer gains.
Awesome. Christian, this was very enlightening. If you guys need any advice at all about taxes, Christian is your man. We have his contact information right here in the video. And of course, if you need anything regarding real estate, we're always here to help. We can either help you ourselves if you're looking to buy, sell, or rent, or if you want to talk to an amazing professional like Christian for any topic related to real estate, please consider us your guide. We'll be happy to connect you with the right people to get you situated the way you need. Christian, thanks so much for being with us today. It was awesome.
Sep, thank you so much for having me, and anytime I can help you out, just knock on the door.
Appreciate it, sir.
Your next door neighbor.
All right. Have a good day, everybody.